We are joined here by the head of Blackrock Investment Institute. Blackrock is the biggest investment manager in the world. Is that correct?
That's correct. Yep. We have largest asset under management.
Thank you so much for being here this morning. Great to see you.
Great to see you. Thanks for having me.
Dr. Bovin served as Deputy Governor of the Bank of Canada and Associate Deputy Finance Minister. He worked as Canada's representative at the G7, G20, and Financial Stability Board. Dr. Bovin has also taught at Columbia Business School. So let's just start with the fiscal policy of the Federal Reserve. The Fed raised rates by 25 points. This marks the first rate hike since 2018. The Fed also signaled it expects to raise rates 6 more times this year, which point to a consensus fund rate of 1.9 by the end of 2022. At the moment, I feel like the Fed is convinced it has to tackle it almost by any means necessary. Do you think there is a possibility that the Fed could accelerate or slow down tightening this year?
Great. Well, thank you very much. I think we saw yesterday the kick of the hiking cycle for the Fed. So I guess it's an important moment. After the COVID shock now. So an important milestone. I think it's very much needed for monetary policy in the U.S. to normalize at this juncture. The restart that we're experiencing doesn't need stimulus. So that's very much welcome. At the same time, however, we feel that the tone of the meeting yesterday and the expectations that the Fed has been putting out in terms of what they will do next is unrealistically hawkish. So to your question more directly, can they accelerate or slow down? I think the risk is more that they will slow down or do less than they intend to do at this stage, because this is a pretty tricky environment, need to normalize, but at the same time, it's going to come with significant challenges. We have the Ukraine situation, we'll come back to that. We have the energy price shock that is playing out. And this normalization will have a slowdown effect. So bottom line is, yes, normalization is happening. We'll see more hikes, but I don't think the Fed will be able to deliver as much as what they've signaled.
The Federal Reserve could kick off the process to shrink its pile of $9 trillion in assets as soon as its next meeting in May. How will it affect the market?
So that's important as well. That's another very important piece. We're quickly moving to not only raising rates, but also starting to tackle the balance sheet part of it. I think that's important. And, it's not something that necessarily affects the short-term rates. But when you think about longer-term rates in the U.S., when you think about like the 10-year yields, I think that's going to be impactful on that part of the curve. So on the one hand, we think the Fed will not be able to necessarily move as quickly in raising rates. On the other, moving forward with the balance sheet reduction is likely to lead to a faster increase in 10-year yield or longer-term rates. So I think this is a world where you could see some steepening of the yield curve because of the two kind of levers that are being used or recalibrated over the next few months.
Not all Wall Street, but some Wall Street analysts have warned of possible stagflation in the U.S. economy. How likely do you think stagflation is in the States?
I think in the United States per se, I don't think this is a baseline scenario. I think there's a powerful underlying restart that is happening. I think there's more sectors of the economy that needs to continue to reopen. Service sector has not recovered to where it was pre-pandemic. So there's a lot of room for the U.S. economy to continue to grow. And so as a result, getting to stagnation or growth that is flat, I don't think is very likely. There's quite a bit of caution in the U.S. growth before we worry about this. That said, we have a pretty significant energy shock that is potentially at play here. The pressure on the energy complex after the invasion of Ukraine is very material.
Sure.
For Europe, this is not your question, but for Europe, the risk of stagnation is more real than it would be for the U.S. This is where I think there's a question to be very questioned in the U.S. I think not likely at this stage. The only scenario where I would see stagnation being like something we want to think seriously about in the U.S. would be if the Fed actually gets too aggressive in tightening policy, in which case we would see inflation not moving down quickly and we could see a pretty significant hurt to growth. So that would be a stagflation scenario. But that's also why I don't think they will be as fast as they intend to be in normalizing rates.
So how much is the possibility of stagflation? Like what percentage do you think?
I don't want to give a sense of, false precision here and exact probability, but I think, this would be more of a tail risk in the U.S. So I would put that, low single digits probability at this stage. That risk will evolve as we see. If the Fed convince themselves and talk themselves into, they believe like we're kind of back in the 1979, 1980, and it's kind of a Volcker moment, that's the scenario where we're going to see more of a stagflation, but I don't think it's very likely at this stage.
What is your prediction on the S&P 500 index this year? Give us a snapshot of the market this year. Should I buy stocks or not?
So, I don't have a number on where the S&P will end up per se, but I think we're expecting 2022 to be a year where at the end of it, we're going to see positive returns out of U.S. equities. In fact, positive returns out of DM equities more broadly. So we are overweight DM equities. So we think this is a place to tilt your portfolio at this juncture, particularly because we think DM government bonds will not be attractive in an environment where inflation is picking up and Fed is raising rates. So as a result, we think when we get to the end of the year, it's going to be a year where we will have seen negative returns in bonds, positive returns in equity, and in U.S. equity in particular. So yes, we think equities U.S. are an interesting place to invest at this juncture.
Oh, you are bullish. Prices in the United States have continued to rise. Jerome Powell also expects high inflation to continue until the middle of this year. How long do you expect the current high inflation to continue? When will be the peak of time?
So I think one of the lessons of the last year, I think, is people got it wrong and very badly wrong and trying to make a call on the exact timing of when inflation will start to wane. I think our view has been for a long time was based on two kind of central view or pillars. The first was that inflation was coming, and this was the most underappreciated risk. We've been saying that since mid of 2020. That is now the reality we're in. The second thing that we've had a strong conviction on is that we've never gone through a restart. We've never gone through a world where we've stopped the economy and then we tried to restart it. And it's very difficult to have a strong view on exactly what the timing is. So I don't have a strong view on the exact timing. I think what is more important, however, is to recognize that what's driving this inflation is really more about the supply side of the economy. It's really like the mismatch between the fact that demand is restarting more quickly than supply, and now we have an energy shock that is coming on top of this. And at some point, these things will wane and will resolve themselves. I think this is something that happened over the course of 2022, and I think by the time we get towards the end of this year, we'll have a different kind of picture on the inflation that will not be as worrying as the surprise of the continues on the upside. But it comes with a high degree of uncertainty. I think it's pretty uncertain the timing of when inflation will fall. I think it's falling eventually. The exact timing, I think, is something we need to remain humble about.
In this volatile and uncertain environment which has made us nervous, do you feel like this volatility is going to continue?
I think this environment, broadly speaking, that we've entered over the past 2 years, which is one, as I said, that is driven by the supply shocks and the supplies of the economy. This is something we haven't seen in the 70s, an environment dominated by, the supply side of the economy. That by its nature is one that is more difficult for central bank and for policy to stabilize. Because anything you try to do to control inflation will mean that you're going to have to destroy activity. And so that conflict is a lot more real in this environment, and that means that it's going to be more volatile as a result. So I think by nature this environment is more volatile. I think we should brace for it as investors. I think portfolios will be showing returns that will be bouncing around a lot more than we've seen over the last decade. But at the same time, it's one where bonds will not be providing as much protection. So as a result, more volatility, yes, is I think the name of the game now for this environment. And yes, we expect more ongoing volatility.
Do you think we'll avoid a recession or an economic downturn in the face of higher rate? I think you answered this one in part, but could you elaborate on that?
Just to make it clear, so stagflation is not like very likely at this stage. Then that implies that recession risk is not like a baseline for sure. We think it's unlikely at this stage. There's quite a bit of buffer in growth and caution before we start to worry about this. However, the history of recessions, right, throughout the last 50 years has been one where it's either caused by oil price shock or central banks over tightening. And those two things have some speck of it like on the horizon right now. So we cannot completely rule that out. And, an over hawkish central bank would be a problem. But that's why I started this conversation by saying we think the hawkishness is unrealistic. So, and the baseline is not a recession.
I want to move on. The war between Russia and Ukraine broke out, and there was a big sell-off, of course, in the U.S. stock market. How do you think the war in Ukraine will affect the U.S. economy? Is there a possibility of a default in Russia?
So I think the main channel of transmission of the situation in Ukraine is what it means for energy. And we've touched a little bit on that already, but the main transmission mechanism for global markets and the global economies is what it's going to mean for energy prices, which means higher cost of production is going to hit into the purchasing power of consumers and will be denting growth by itself. We still don't have full visibility on how sustained the run-up in energy price we've seen will be. If you go back to where we were last week, at those levels, for Europe, it was at the level of a shock that was like the 1970s. It was equivalent in terms of magnitude. Since then, we've seen a 55% decline, in natural gas. So, it's bouncing around, so we still don't have full visibility. But the main channel of transmission from Ukraine tensions and invasion is through the energy complex. We are effectively kind of stranding the production of oil in one part of the world. That means price elsewhere will have to go up considerably. That's going to hit in the pockets of consumers. It's going to slow down growth, and central banks will have to deal with that. So that's the transmission. That's the main impact. I think it's bigger impact for Europe than for the U.S. And that's where, we're going to see also more inflation and more persistent inflation on the back of this. That's the main mechanism. And I think on the financial stability side of things, we'll see exactly how it's being dealt with in terms of, payments and so on. But I think on that front, authorities have the means and tools to prevent contagion from that. So people will be paying attention on specific payments. But for the global investors, I think I have confidence that authorities globally have the means to contain any contagion that could come out of near-term technical difficulties.
In this situation, what industries or sectors are better to invest in?
I think the main sectoral industry thematic story at this juncture is really about what I would call, broadly speaking, the climate transition, which the situation in Ukraine has accelerated in our view. So, as I was saying before, the main contagion or transmission from the situation is through energy prices. Energy price, what I mean, it's oil prices, it's natural gas prices. Effectively, what does happen is we've stranded some assets, traditional energy assets in Russia. That has boosted the price of energy elsewhere, which is kind of a carbon tax, some tax on energy that the governments have been trying to put in place. Like this situation has kind of effectively put in place a carbon tax on fossil fuel. And I think that's going to accelerate the incentive to transition for consumers. So, the calculus now between how you get your energy has changed. I think consumer will change their behavior. So the sectors I think will benefit in the near term, like the energy complex is a sector that benefits from the situation we're in. But renewable, I think, have a tailwind that's going to become even stronger now as a result of this. And tracing out the acceleration of the climate transition across sectors is the key theme, I think, investment team that comes out of the current situation.
As we all know, the European Union is also fighting inflation as well. Do you think the European Central Bank will raise the interest rate this year?
Everything that I've said, we've said before about the U.S. Applies for the ECB. So this situation that the ECB is facing, I think, is even more challenging. They're really in a bind because on the one hand, inflation is running higher and in levels we haven't seen in Europe for a long time. But on the other hand, the growth shock that Europe is facing, the adverse growth shock that Europe is facing, is even more important. I think, as we said before, I think Europe is facing more of a real risk of stagflation.
Yes.
And so right now, I think the problem is that if you look at what the ECB announced 2 weeks ago, their forecast of growth doesn't make any account or serious account of the growth shock that is coming from Ukraine and the energy price, crisis that is coming out of this. So I expect them to revise their growth forecast over time downward. And as a result, I think it's going to be hard for them to start really normalizing as the intent. So I think, a rate hike before the end of the year in Europe is kind of a 50% chance in my view.
Let me ask you the last question. What is your view on Asian market, including China and Korea this year?
We've been, on a strategic basis, longer term, and on a more tactical basis, we've been favorable and overweight the region. That's true since last fall. We have been of the view that there was a policy complex that would be more supportive coming into 2022. So this is our starting point view. Of course, some of the teasers behind that has been questioned over the last couple of weeks. We've seen markets being very, very volatile. I think there are questions around the growth outlook. There's the COVID situation that is worse than expected right now. So how bad will that be for growth is now a question on the table. And then there's the broader geopolitics that is also very much in our client's mind. So as a result of this, starting point is favorable, positive, but at the same time, there are questions now that we need to address and think about what that means and reflect, markets. I would say a greater market nervousness at this juncture, which could take one direction or the other over the next few weeks. So that's what we're going to be tracking and looking for.
It was a pleasure to have you here. Thank you for your time and insight today. We really appreciate it. Bovin from Blackrock.